Good afternoon, everybody. Welcome. My name is Francisco Sirvent with Keystone Law Firm, Lifestyle Planning, and our Retirement Management Office. Today, we have a little bit of a more technical topic. Going to be diving into some pretty deep tax stuff. So I'll do my best to break it down and inch our way through this and not overwhelm anybody. Before we dive in, if you see settings on your screen that indicate this is being recorded, it's because it is. We are recording this for those folks who couldn't attend today live, and we're going to be sharing it on our YouTube channel publicly. So look out for when that is posted. We have been able to, through my amazing team member, Alexis, he has gotten all of our prior webinars up and posted on our YouTube channel. If you want to watch any of those, you just go to youtube.com/Keystone Law Firm, and you'll see those under our long form playlist. All of them are there. They're available. You just go to YouTube, you hit play, and it'll be right there for you to consume any of the topics that we've done in the past. And the same thing will be with this. The same thing is true with this one. If you have questions, I'm going to have time for questions as I go through this. I won't have as much time today as I normally do because I have a lot to go through, but I will make sure I get some time in for questions. Just so you know about questions, though, because this is being recorded and will be shared publicly, keep your questions as generic as possible. I don't want you to share anything that's private about your situation. But feel free to interrupt me and say, what did you mean by that? Or whatever. While we're going, I've got everybody's microphones muted so that we don't pick up any interference of noise on your end. I'll open up the mics towards the end when I'm done. You can pop questions in the chat at any time. Towards the end, you'll be able to just unmute your microphone and say, well, what about this or that? The next webinar we're doing, I do want to let you know about that, is coming up, and it's on September 30th, so don't miss that one. Michelle Dexter, my partner, is going to be talking about what can be done to help in your planning if you have a beneficiary, a child, a grandchild, a niece, nephew, anybody that you want to include in your plan who has special needs. There's a lot of unique rules around that and how to make sure they continue to get their benefits that they are already qualified for, even if you want to leave them money. So there's ways to do it, there's right ways to do it, and Michelle's going to go over those on September 30th. Alexis will post the link to register for that one if you haven't already in the chat here before we sign off. So you can just click right there and register for that. Again, completely free, open to anybody. If you know somebody who has a special needs child or beneficiary, send the link to them so they can register. They're welcome to join. All right, let's dig in. So what are we talking about today? We're talking about IRAs and 401ks specifically. If you came to the last one with Carmi Gutman, he talked about annuities and how to read your annuity statement, and some annuities are also IRAs, so it might fall into that category for you. But we're going to talk about what you can do about the giant tax bomb that comes from an IRA. So just to give everybody a quick overview before I dive into the technical strategies about how to deal with those taxes, here's what I'm talking about. So your IRA, this was money that we contributed while we were working, and every dollar you put into an IRA or a 401k, every dollar came off of your taxable income during the year you made that contribution, okay? As life goes on, you get to the point where there's something called an RMD, okay? And that's really what triggers a lot of the problems with IRAs. And I'm going to call them IRAs. 401ks have the same rules about distributions and taxability. So I'm going to use IRAs just for simplicity's sake, but it's both of those. So RMDs are the required minimum distribution. We got to start here at the foundation before I get to the strategies about how to reduce the taxes on these things. The RMDs are the required minimum distributions. Most people at the age of 73 are forced to start taking withdrawals out of their IRAs. So generally speaking, you contributed, and you probably had it invested in some stocks, some mutual funds, some ETFs, just something so that it would grow over time. And so those account balances grow over time, generally speaking. Maybe you put it into an annuity and that annuity is growing too. Either way, whether it's an annuity or stocks or mutual funds or even a self-directed IRA, whatever kind of IRA investment you have, it is going to require distributions at your RMD age. Most people, it's 73 years old. So in that year, you got to take your first distribution. So what happens at that age is whether you want the money or not, you've got to take a certain minimum amount out of that account or else there's big penalties and it's not worth incurring the penalty. So you take it out and that money is now fully taxable income to you in the year you take it out. Here's the big problem with this. So as we, I don't know, let's say this chart goes from age 55 to age 90, just for an example. We're working and our income is, whatever it is, it's trucking along. Maybe we're making a little bit more money as time goes on, but then at some age we retire and our income is going to drop. Well, as you get up to your RMD age, and I'm just going to use 73, you're forced to watch your income start to go up. And the reason it continues to grow over your lifetime is because that RMD amount continues to go up each year. It gets larger and larger and larger as you grow. So even if all you have in retirement as income is Social Security, which is only going to grow by the cost of living, just a teeny little bit every year, your distribution from your IRA is going to grow much faster. And so as you get older, that RMD is getting bigger and bigger and bigger. And that's the big problem with IRAs, is that whether you need it or not, your taxable income is going to grow through your retirement significantly. And if you're distributing, if you're taking out of your IRAs less than the account is growing, then it's going to be growing even faster. Your RMDs are growing even faster. And that's where the tax problem happens. And then it happens at a second level, which might be triggered at our death, wherever that is, because at that point, now the IRAs have to be distributed to your beneficiaries, okay? And that's a whole big question mark of what is their taxable income. So just to put a point on this, if we pass away, whatever age, 80, 85, 90, 95, 100, whatever age we die, our beneficiaries, if it's our children, are probably going to be about, 25, 30 years younger. So they're going to be right, guess where? Right at that age when they're still working. And so the distributions they take from the IRAs are going to add on top of their taxable income while they're working. And so that's another big problem with the tax bomb inside IRAs. So finding some ways to deal with these taxes is the point of today's webinar. I get some people that sit with me and talk about this, and they've got Social Security, maybe they've got a little pension income. They sort of have enough retirement income that covers most of their bills. And so they don't really need the big distributions from their IRAs. They're just continuing to let it grow. And they're like, well, I don't need it. I'm just going to let it keep staying in those accounts. And I hear that a lot. I mean, I was sitting with a couple who probably 81, 82 years old, and that's totally what they've done. They just didn't need the money, and they had other sources that they pulled from to live their retirement. They've done a great job. But now that they're at that age, their RMDs are approaching $50, $60, $70, $80,000 a year. And that's a big amount of taxable income that they don't need. And so as they're looking at it at that age, they're going, why are we being taxed on all this money? Well, they have options at that age. Hopefully, I'm catching some of you in some younger years so I can give you more options, because the younger you start these tax plans, the better your options are longer term. And they're looking at their IRA thinking, we're really never going to spend it. So it's going to get inherited by our kids. And all of our kids are in that younger year where it's just going to stack on top of all of their income. So it's this really, really big tax problem, especially when nobody needs the money. So watch out for these. And I'm going to go through 6 strategies. And trust me, when I say I don't believe all of these are applicable to everybody on this call, I believe it. I truly don't think all of these are applicable to everybody on this call. Maybe 1, maybe 2, maybe you can pick and choose. But out of the 6 things that I'm going to talk about, these are the 6 things that we at least initially evaluate with someone when we're sitting down looking at this tax bill. Because there might be one that could save you and your estate maybe hundreds of thousands of dollars in taxes by implementing some of these things early enough. Okay, so just take that whole thing as the preface of how I'm going to present this. I also just want to highlight this little timeline, or this little line here of somebody's income over their retirement years. A lot of people haven't been shown this before, but this little stage right in here, whatever age that is for you, this is a real important window. If you are coming up to retirement, you're not yet at the RMD age, or maybe you are and the RMDs aren't that big yet. This is a real window of opportunity that I want everybody here to know about. And if you know somebody in that age range, maybe 60, 62, make sure you tell them this is a huge tax planning window for retirement accounts. There's so many opportunities right in here that if you can capture it, you can really, really, really make a big difference. So just also, let's go into that with this little window as the real opportunity. I also want to just highlight, what is your tax? Like, how does this figure into your tax? Okay, so remember, your tax is calculated in the US at a federal level on a progressive tax chart. And I just want to highlight what that is real quick. So, we all do our taxes. Hopefully everyone finished theirs this year. I'm just about to finish mine. I'm on an extension. Your adjusted gross income is kind of the starting point after, you add up all your sources of income, you take off, certain contributions, and then you get your standard deduction if you don't itemize. And that's what your taxable income is. And that's what determines what bracket you're in. So your taxable income is all your sources of income. It could be Social Security, could be pension, it could be capital gains, it will be your IRA distributions, it could be business income. All of that gets added up to figure this out, and then your taxable income is going to determine your bracket. And that's where we start with the planning. So just a recap of how these brackets work. Okay, 2025, these are the current brackets. And the way the brackets work is it's like a little bit of a waterfall or bucket analogy. Your first layer of income is taxed at that first layer, okay? And then it's only the dollars over that in the second range, if you're married or if you're single, that get taxed at that next level. So each time you have any dollars of income that go above the next level, it's those additional dollars that get taxed at that rate. So if you think about this, if you think about like this chart and how this works here at our federal tax level, One of the biggest jumps in taxes and in your tax rate is when you go from this level to this level, because it goes from 12% to 22%. I mean, it's almost double the tax, right? I mean, think about that. That's a double, almost double the tax rate. The next biggest jump is from 24 to 32. That's almost a 50% jump in your tax rate at those dollars. So it's not that all of your income is going to be taxed at that bracket, but any additional income is going to be taxed at that bracket. So managing which bracket you're in has a huge impact on your tax bill. It also has a huge impact on things like which capital gains tax rate you're going to be paying. And it has also a big impact on whether you're going to be paying any Medicare premium surcharges for IRMA. So watching these brackets, watching your additional income during any given year and managing that so you're not unintentionally bumping things up to the next level is really key to minimizing the taxes. We just we're talking with a client who did some things earlier, either last year or earlier this year, not knowing that it was going to trigger some additional income for them this year. And that not only bumped them into another tax bracket, but it triggered Medicare IRMA surcharge on their premium. And it's just painful when that happens accidentally. So calculating these things on a like a forecast basis is totally doable. It just requires sitting down with your numbers and watching what these brackets are so you don't do it unintentionally, okay? So that's how these brackets work, and I really want to highlight that that's a big part of all of these plans, is watching that you don't get into a bracket accidentally. Okay, so where are we going first? I'm going to cover 6 main strategies, okay? 6 main strategies. The first one is one of the simplest, and it is surprising to me that I still talk to people and tell them about this strategy and they go, never heard about that. So I start with it. And you guys, if you've been on webinars with me before, you've heard me say that, and I'm going to say it again. It's the Roth conversion, okay? I just sat down with somebody who's 83, and he's never heard about it. And okay, that hadn't heard about it. Let's talk about it. Let's learn about it. What is a Roth conversion? Just the fundamentals. If you contribute money to an IRA, actually, let me just go this direction. Think about it in these 3 categories, okay? You've got 3 buckets. You've got taxable income, you've got tax deferred income, and you've got tax-free income. These are the 3 buckets of income. It's either taxable, like your wages, like Social Security to a certain extent, like distributions from an IRA, bonuses, capital gains, those things are all in your taxable bucket. Tax deferred are things like IRAs, 401k, because you didn't pay taxes on the money when it went in there. You actually got a deduction. As it grew, it's deferred, but when you pull it out, it's now ordinary income. Tax-free is something like distributions from a Roth account. So when you take money out of a Roth account, you pay 0 income tax on it. It's tax-free what you pull out of there. So those are the 3 categories. A Roth conversion is basically taking money that is in an IRA or investments, it can be anything inside an IRA account, and making a choice to put it into a Roth IRA account, okay? And it's moving it from one to the other. When you do that, when you make that move, that amount converted is income to you in the year you do it. So it's not a tax-free move. So if you decide I want to convert 100,000 of my IRA balance into a Roth account, that 100,000 is going to be added to your income in the year you do that conversion. That's how it works. So you've got more income in the year you do it. Okay. When you look at numbers and you play the game of a Roth conversion, the real reason you do a Roth conversion, there's two real reasons. You're going to pay the tax now, hoping that later we expect tax rates would be higher. Okay. I think we all kind of look at our political landscape and the spending of the federal government and the deficits and things like that, and we think there's no way tax rates can't be higher in the future. And so we choose to pay the tax now so that when tax rates are higher in the future, we're not paying that tax rate. We're paying the tax rate at a lower tax rate today. You can and you should, when you do a conversion, reinvest, make that money grow, do the same kind of thing you would always do. And so it continues to grow in a Roth. All that growth, when you pull it out, it's tax-free. It's not going to be taxable as capital gains or ordinary income. So you're not paying it at future higher tax rates, which is what we all expect. That's the first reason. The second reason is for inheritance purposes. Okay. Like I said earlier, when an IRA is inherited by children, beneficiaries, grandkids, whoever, and they take distributions out of it, it's now income to them. It's added on top of their income. So they have to pay taxes on that distribution at their top bracket, or if it moves them into higher brackets, they're paying taxes on that distribution at those highest tax bracket rates. Okay, so that's a taxable income to them if they inherit an IRA. If you convert it to a Roth and they inherit a Roth and they take distributions, there's no income tax to them for those Roth distributions. So that's the second reason to consider doing a Roth conversion. For some clients, that's good enough reason in and of itself, because they're not going to use the IRA. They might as well leave it to them in a tax-free manner, convert it to a Roth. You can't leave somebody an inheritance as an IRA and have them convert it to a Roth. There's no ability under current tax law for somebody who inherits an IRA to convert it to a Roth IRA. It's not possible. If your spouse inherits it, there's different spousal rules. That spouse can do that. But those are two reasons why you might consider doing a Roth conversion, is simply to avoid future higher tax rates and to let the inheritance be tax-free. So it's not taxable to them because they can't do the conversion themselves. One big issue with Roth conversions. When you do this, you are moving the account number does change, right? The IRA has account number, blah, blah, blah. The Roth IRA account has a different account number. The Roth IRA account has to have been open for 5 years in order for it to fall under all the most favorable tax treatments. So if you do it all in 1 year or do it all over or a couple years and then you pass away and leave it, it doesn't get all the best tax treatment. So that doesn't mean you have to do all the conversions 5 years in the past. The account just has to have been open for 5 years. So maybe you do a Roth conversion of $1 and you get that Roth account open and let it sit for 5 years, right? You can do the conversions later. That account just has to have been open for 5 years. So if you don't have a Roth account open, I recommend you open one, you do some mini conversion just to get that clock ticking. And then if you want to figure out later all the numbers that I'm talking about, fine, but get that Roth account open so you can at least consider doing this and have had that 5-year clock already ticking behind you. But Roth conversions are the first thing to consider. Just crunch the numbers, figure out what you want to do, and then think about maybe this window right here where there's this little window of opportunity where your income is lower and you're in lower tax brackets. Maybe those are the years to do some Roth conversions because you're already in lower brackets. And if you can convert it over at lower tax brackets, that's a huge win. Okay, so that's the first one, is Roth conversions. Second thing I want to talk about is something a little bit advanced, but it's not huge. It's not a hugely advanced strategy. Number two is something called a qualified charitable distribution. Obviously, this requires you to be charitably motivated from the get-go. This type of charitable strategy does not put more money in your pocket directly like some other charitable strategies might. What this one does is, as you get to the RMD age and you're looking at your IRA and you're thinking, I don't need this money, but maybe you're already out of your, remember I said there were those 3 buckets, right? You've got the tax-free, you've got the tax-deferred, and you've got the taxable. Maybe you're giving gifts to church or other charities out of your checking account every year, and you just write them that check, and it's your gift to charity. Awesome. Keep doing that. But instead, when you get to your RMD age, don't give it out of your checking account. Give that gift out of your IRA. Your IRA can directly give to charity, and that's called a QCD. It's called a qualified charitable distribution. What happens is, you say you have your IRAs at Schwab. You contact Schwab and you say, I want to give a distribution directly from my IRA to my church, to the Red Cross, to whoever it is, and fill out some forms. You say how much and hit sign or submit, whatever they do. And then what Schwab does is they actually write a check directly from your IRA to the charity. And doing it as a QCD, as a qualified charitable distribution, does 2 things. First, it satisfies your RMD requirement for that year. So if you have an RMD requirement of $10,000 this year, and you normally give $5,000 a year to charity, give that $5,000 directly out of your IRA. And you can give the other $5,000 regular out of your checking account or however you do it. But give that money directly out of your IRA because it'll satisfy that portion of your RMD. And you won't then have to take that full RMD as income. You will just have a portion that went to charity, satisfying part of your RMD, and then the rest then will satisfy your RMD. Some of our clients, they're so charitably motivated, they're doing their whole RMD to charity because they do it anyway, and they don't want the extra taxable income. So give it out of your IRA using QCD directly to the charity. You won't then have extra income, which helps you with your Medicare surcharge problem, helps you with your tax bracket issue, helps you with what capital gain bracket you're going to be in. It helps on a lot of different fronts for taxes. So you reduce your income, you don't have that extra RMD distribution, you get to do your charitable giving, and it's not coming out of your checking account, which is after tax dollars already. You already paid taxes on those dollars. And now with the standard deductions being so high, a lot of us aren't getting to deduct our charitable giving anyway, right? We're taking the standard deduction, and that's more than my charitable giving. So I don't even get a tax benefit when I write a check out of my checking account. So put this on your list of things to consider. I think this is one a lot of people should consider doing because it takes care of the problem from the get-go. And it's very simple. You don't have to figure out anything. You just go to your custodian who's holding your IRA and you say, I want to do a qualified charitable distribution. You do the paperwork with them and you get that thing sent out the door. It always takes them a while, so don't do it at the end of the year. Don't, wait to the last minute. You can't do it next year to satisfy this year. It's got to be done this year so that you don't incur penalties and make sure you've covered it. Now, how do you figure out your RMD? If you've got accounts spread out across different institutions, you're going to have to do the math and figure it out. Each institution is supposed to give you a statement after the close of the calendar year of what your RMD is for the account they hold. So you should be able to add those up and figure that out. So that's strategy number 2. Strategy number 3 and 4 are a little bit advanced, but I'm going to cover them. So strategies 3 and 4 are, number 3 and number 4 are ways that reduce your total taxable income, okay? So think about your total taxable income, like I talked about a minute ago. Let me grab that question that just came in chat real quick. Let's see, is it possible or advisable to pay for your charitable donations from an IRA before you hit RMD age? That's a great question. Can you do QCDs before RMD age? I don't know the answer to that off the top of my head, Laura, but I will get that answer and email it out to everybody. That's a great question. I don't want to answer that without knowing exactly. I haven't been asked that before. Maybe. I know it's not, it doesn't, the QCDs don't work. You can't like give from your checking account, or I'm sorry, you can't take a distribution from your IRA and then give to a charity and get the full deduction. I know you can't do that. The QCDs are directly from the IRA. And can you do that before RMD age? I don't know. So Laura, I'll get back to you on that one. That's a great question. So strategies 3 and 4, if you remember, we talked about your taxable income. And that's after your standard deduction, okay? And now let me go back. Your AGI minus your standard deduction equals your taxable income. These two strategies, what they do is you actually won't use your standard deduction. You'll take your AGI and you'll use some strategies to basically increase your deductions, okay? Increasing your deductions to reduce your taxable income. So these strategies are in place of your standard deduction. That's what this is. It's going to give you bigger deductions. The best types of deductions that I like are ones that you get the benefit of the deduction. And so here's what I mean. You know, there's all kinds of ways you can get deductions, right? Give money to charity. And again, these are all things that are more than your standard deduction. It's the only way you get these benefits. You give a bunch of money to charity, you're going to get a bigger deduction than your standard deduction. The other ones are things like certain types of investments in things that the federal government has set rules in place that have tax preferred results. Here's the two. So, and these are weird, these are alternative. Again, they don't fit everybody. I'm going to go over them. Solar tax credits and certain energy investments. Solar tax credits and energy investments. Solar tax credits are a really unique thing because it's not just a deduction, it's also a tax credit. So if you think about how these work, you get deductions off of your income, then you figure out what your tax bill is. If you have something you qualify for a credit, you know, your tax bill was $5,000 last year. If you have a tax credit, it might offset your tax bill dollar for dollar. The deduction reduces your income, but a tax credit pays for your tax bill. So that's what these solar tax credits are. So the way they work is you decide, you know what, I don't want to pay a bunch of taxes this year. And I want to fund something like this unique solar investment. Okay, and are these going away after 9/30/25? No, the One Big Beautiful Bill Act extended these tax credits. There's multiple different types of them. Some were extended for 3 years, some even longer. So lots of different varieties here. But the way it works is, let's say you really want to do a Roth conversion. You really want to get this money out of the IRA because, man, I'm not going to spend it all. It's going to be left as an inheritance, but I really don't want to pay a big giant tax bill. You know, you've got $500,000 in your IRA. You really want to get it out. Well, if you just pull $500,000 out and move it to a Roth account, that's going to trigger approximately a 40% tax bill. Think about that. Like $500,000 converted to a Roth is going to have a tax bill of $200,000. That hurts. That account balance drops. Okay. But say you really feel like you want to do it because you're going to get to leave it as a tax-free inheritance. Well, one way you can do this is you can say, I'm going to do that, but it's going to have a $200,000 tax bill. Well, there are, if you look at the most preferred solar tax credit type of investments, you can take and put $200,000 into that solar tax deal, and you invest in and you help a school, you help a church, you help a commercial company put a solar array on their business, their house, their whatever, and it's going to cost a bunch of money to do that, but you invest with the solar developer, they build it, they get through the project, takes 2 months, 3 months, whatever it takes, and then at the end of the year, you get a K-1 that says, here's all your tax deductions and your tax credits. And those are itemized to you on a K-1 as the investor. And the most preferred of these types of investments actually can return to you something like 1.1 to 1.5 times your investment amount in tax dollars. Not for everybody, because these investments are alternative, they're complex, they're different. But imagine that if your tax bill on a conversion is $200,000, and instead of paying the IRS $200,000, you can put it into a solar tax deal and then get that back out of the tax bill on your IRA conversion from 1.1 to 1.5x. That's a huge return. You're basically saving all the tax dollars, and now instead of paying the IRS 200 grand, you own part of a solar investment, solar array that's over there. And you get all these tax credits and tax benefits offsetting. So now your Roth account isn't destroyed by that conversion. These are house solar tax credits. It takes a lot of calculations and working with the right solar developer to make sure these things are done correctly. But that's what the solar tax credit program does. There's just huge incentives at the federal level to put solar systems out there and generate energy from solar. So there's huge tax benefits to do so. This is how solar tax credits work. Okay. The next alternative thing is energy investments. Energy investments are ridiculously speculative, very risky, not anything somebody should just go do. It's for people who have done it before or have interest in testing a small thing and learning about it and growing over time. Again, these have huge federal tax incentives for people to help inside the United States develop additional energy resources. And so the one of the easiest ones to understand is when it goes into developing oil and gas reserves inside the United States. Inside the United States, we have a lot of oil and gas development. There's a lot of development happening, especially this year, that's just starting to boom. And so it's also very risky because you got a lot of people jumping into it who've never been in it before. But here's how the tax side of it works. It's not a tax credit like the solar side. This is a deduction. So it takes it off the top of your income, reduces your income, so your tax bill is smaller. So again, you want to do a Roth conversion, you have $100,000 that you want to convert, and so if it's at a 25% tax bracket, that's a $25,000 tax bill. So, but if you do that conversion, you're going to have $100,000 of extra tax this year. Well, you could let's just make the number easy. Say you put $100,000 into something that qualifies for this deduction. You invest in oil and gas. You buy something in that industry. Well, the way it works, there's two parts of it. Because you're basically investing in a business, businesses get to deduct things that are depreciable, right? If, like me and my business, if I buy more computers, if I buy file cabinets, if I buy, another copier, all kinds of things, right? We get to deduct those expenses. Same thing in any business, but oil and gas has an extra special thing. So they get the standard deductions for those kinds of expenses, but they get something even extra. It's called intangible drilling cost, IDCs. So they get this extra deduction that helps offset your income. But here's what's even more amazing. Because of these two things, you actually qualify to offset some of your ordinary income, which is what an IRA Roth conversion triggers is ordinary income. So you can use a lot of this to actually offset ordinary income from other sources. And that's rare because when you put money into a business that you're not actively a participant in, you can't typically use those deductions in that business to offset ordinary income from another part of life. But with energy, you can. And so you get to have ordinary income from your Roth conversion and expenses on this that can offset it, which is amazing because if you've got a big tax bill from a Roth conversion that you can offset from something else you're investing in and you own, then you're playing with house money. You're basically playing with the IRS's dollars. Again, these are just incentives that have been created at the federal level to incentivize all of us to put money into these things. And it's a huge incentive if you look at the numbers and how you can play basically with the house money, play with the IRS dollars. Instead of it going to the IRS, let's put it back into an investment that I own. Generally, these are, like I said, they're very alternative. They're very unique. They're not things you should just jump into blindsided because there's a lot of companies out there that can't deliver on these things. They pop up and they say we can, and then it's no good. So, but those are two sort of advanced alternative things that can be used, and we have clients this year that are using both of these to reduce their tax bill. All right, let's go to strategy number 5. Let's see. All right, we did that one, we did that one, we did that one, we did that one. Okay, so number 5 is something a little different. It's not really a tax strategy. This is something more of a new development that we just found out, and Carmi touched on this last week in the webinar, is a special kind of annuity that companies are offering now. So if you attended last week, you learned that some annuities, when you put money into it, they offer you a bonus of some kind. And all kinds of rules and restrictions around annuities. So it's not free money. But if you understand all the restrictions and rules about it, and the bonus makes sense, a lot of times you can actually get a big enough bonus on the annuity that it offsets the conversion. So, you have an IRA and you want to convert $100,000, but if you do that, your tax bill might be $25,000. Well, if you convert that into one of these special kinds of annuities, it's going to be a Roth IRA annuity. Instead of it starting out with a starting balance of, say, $75,000, they will give you a bonus of something that, in what we're seeing right now, actually makes up for the $25,000. And so the bonus gives you that money back, in a way, inside the annuity wrapper, with all the annuity rules and restrictions and regulations. But if you understand all those, and those make sense for you, this is a really cool way to do it. Really simple. You just take your IRA, plop it into this annuity. If you like the rules, regulations, and restrictions, you really helped offset that tax bill. It's a really simple, elegant way to do it. So put that on your list, is maybe there's a special kind of annuity that can help me do the Roth conversion. And again, once it's in a Roth wrapper, the annuity itself is not going to have RMDs. So you can leave it there. It can be left to your beneficiaries. All these things apply like a normal Roth account would get. Okay. Let's look at strategy number 6. Strategy number 6 is something I'm probably going to have to do a full webinar on its own, but let's touch on it. It's a charitable remainder trust. Charitable remainder trusts are a charity. So you have to have some charitable intent for this to make sense. If you are giving to charity during your life, if you're giving to charity out of your estate plan, this might be a beautifully elegant way to really supercharge what your charity gets and what your beneficiaries get. So the way it works is, living your life at the point of inheritance, instead of leaving an IRA directly to your beneficiaries, you leave it to a new kind of trust just the IRA, not everything, called the charitable remainder trust. Goes to the charitable remainder trust. Immediately at that point, your beneficiaries are not given the 10-year distribution rule. That's what's typically required when you inherit an IRA. They have to receive the distributions over 10 years. They have to drain that account over 10 years. What that does is it extends the distribution to 20 years. Okay, so when you extend the distribution, if you're not forcing 1/10 out each year, you're now forcing 1/20th out. It's a smaller amount, right? Which is going to be lower in the tax brackets. So that's a good thing. And it's for a longer time period. So we're letting things grow. So what happens is the estate gets a really valuable deduction at this point for doing that. And the money can grow in this, can be invested, can be managed, however you want, can grow in this. They get their distributions each year for 20 years. And then at the end, you pick the charity that the rest goes to at that point. Okay, so it's 20 years for the beneficiaries, and then it's charity outright at the end of 20 years. And by running through the numbers of all of this, you can find ways to reduce that tax bill significantly that the beneficiaries are going to experience. It's a really elegant way to do it. It requires some setup. It requires some ongoing understanding of how this is going to work. But in essence, you give them a 20-year annuity. It doesn't have to be an actual annuity, but you give them 20-year income stream, and then you give the charitable gift at the end. And when you look at the numbers, a lot of times you can see a huge advantage on how much each group is getting, okay? There's generally a lot more money available to both. So that's the last strategy I want to go over. There's a lot to this stuff, balancing, figuring out which ones work and what the impact will be on you, your life, your beneficiaries' lives. There's a lot to figure inside of all of that. You don't do this stuff just haphazard. You run the numbers, you figure it out, you see what the rules and the restrictions are, and then you assess, does this fit my situation? And I promise you, none of these are identical from client to client to client. So those are the 6 things. I wanted to plant those seeds in everybody's mind, give you guys at least the tidbits of the most common strategies we look at, so there are things that can be done. I hate when I sit down with somebody who's 75, 80, 85, almost 90, and they say, I didn't even know about these things. I wish I would have known younger. Please, if you have kids who are 50, 55, 60, share this recording with them, because they need to know this stuff as they're getting closer to retirement. If you're 65, 70, 75, and you're thinking, I'm not going to spend all my IRA, these things really should be packed into your plan so that you reduce the overall tax bill. All right, we can jump to Q&A. Let me change my settings here, and you can pop on your microphone if you want and ask me a question. I see something in the chat. In my IRA, I have a significant money amount in stock that I rolled over from previous employer's 401k. What if I want to keep that stock when I convert to a Roth? You absolutely can keep your investments the same when you move it in a Roth conversion. So that's totally allowable. And the word that's in the industry is, it's called, you journal it over. You journal it from this account to this account. It still has the tax impact, so you'll still owe the tax, right, on that amount, but you can still own those stock in your Roth account. There's no restrictions that says you can't, unless you're at some custodian that doesn't allow it or whatever. But yes, if you own stocks ABC, you can own stocks ABC in your Roth account without any problems. Good question. Let's see, we've got some hands up. Let's see. Laura, did we get your question answered? I know I need to look it up and get back to you, but was there another question? Carl, go ahead, buddy.
Yeah, Gina has worked for churches for a long time, so she had no qualified plans. So that she opened her own Roth, and said she had a Roth, I could do it, even though I've been retired 12 years. But there's a limit.
Yeah.
But if you're going to take out, say you have an RMD of 50,000, can you put that all in a Roth, or is there a limit?
So the contribution, so there's two things that apply in a Roth. So if you've got a Roth account over here, there's one limit, and that's for contributions. Okay. Contributions to a Roth are based on a federal limit. This year, let me look it up. Roth IRA contribution limit, I think it's $7,000. Yeah, $7,000. If you're over 50, you can do $8,000. So $7,000 a year for contributions from your earned income.
Right.
So contributions are only allowed if you have earned income during the year. Conversions from an IRA don't have a limit.
Okay, you have to set that up front. You just, right? So if you have maybe you'd want to continue with the Roth we already have. See, we're
Yeah,
both,
so you can contribute to a Roth, you can do contributions and conversions into the same Roth account.
okay, but we'd have to get with the people that are running the Roth to do that, right?
Yeah, you'll have to work with whoever manages the account or the custodian.
Because we both hit that $8,000 limit, and there's other stuff we could do. But thank you, appreciate it.
Yep, absolutely. Laura, yep, I'll get back to you on your question. Absolutely. Jim, with the CRT, what is the minimum amount that must be included in the charitable distribution after 20 years? It's a pretty complex conversation. It requires a whole bunch of accounting stuff. But with a CRT, when you get to that point where it's 20 years later and it's going to charity, what happens is the setup happens at the point the CRT is funded with the IRA, and that's when the calculations have to work. And so generally speaking, you're looking for a 10% net present value at the point of setup. So you run the math, you project it out for 20 years, and then you sort of back calculate how much the net present value is of that gift 20 years from now, and the net present value generally has to fit the 10% rule. So you're looking for that. Now, I'll tell you, the time value of money. 10% of, $100,000 today is not what the dollars are in 20 years, right? If I today say the value is $10,000, the net present value is $10,000, but the actual gift 20 years from now might be $100,000 because it grew over time. The net present value back calculates it to today's dollar figures. So that is a calculation that has to fit the overall scheme of it. But the general rule is going to be a 10% net present value, Jim. Barbara, is there a maximum you can donate your RMD to a charity? Actually, that's a great question. There's not a maximum, but what a lot of people are doing out of their IRAs is just the amount of their RMD to satisfy the RMD requirement. But you can, or I'm sorry, the QCDs have maybe it's $100,000. Let me look that up. QCD, I think it might be $100,000. 108 this year. Yeah, so it's 108 this year. That's the maximum to get the qualified amount to work. So you can peel it off, give it to charity. It's not going to be added to your income. You also don't get a charitable deduction on your other income, though. Just remember that. So it's going out of your IRA. You don't get a charitable deduction against Social Security, pension, and other stuff. So the QCD goes directly, but that's generally, that's the limit. Thanks for asking that. 108,000 for individual, 216,000 for married couples. Yep, there you go. Let me see if I can get Laura's question answered real quick. Laura, can you do QCDs? before RMD age. I think it's no. Oh, the limit is 75 and a half. Let's see. 75 and a half. Yes, you have to wait until you're 75 and a half to do QCDs. So you can do it a little bit before your RMD age. And that's on the IRS website. 75 and a half or over when the distribution is made using a QCD. Okay, so there's your answer, Laura. Let's see, Helen, is a CRT a separate trust from a revocable trust? Yep, totally separate because of all the charitable rules and calculations and things, and it only receives an IRA, whereas your regular revocable trust might receive your house, your other stuff. So it's just a tax-specific trust for charitable, for that charitable plan. So it's totally separate. Yep. Good point, Helen. We are coming up to the end. Any other questions? I'm happy to answer. If this sparked a thought you want to have a conversation with me about, let me drop my calendar link in there. It's free. Schedule with me. It's a quick 15-minute call. No charge, no catch, nothing about that. I'll just brainstorm with you. Feel free to grab a time. If you don't see a time on that scheduling link that works for you, you're welcome to call or text my office and they'll find a time for you. We'll just chit chat about whatever the issue is and give you any ideas I can. If there's obviously work I need to do or my team needs to do, I'll let you know what that would look like. But a lot of times I can point you in the right direction. But yeah, so there you go. The next webinar, if you want to register for that, Alexis will drop that into the chat. Click on that and register right there. Also look out for emails. We'll be announcing that one. If you haven't seen the emails yet, you can click on those links to register anytime, but it's next week at next week on the 30th, or sorry, 2 weeks out on the 30th. And Michelle's doing that one right at noon, and that's on the special needs planning options for special needs beneficiaries. All right, guys, everybody, thanks for coming. Have a great rest of your day, and feel free to share the recording once it's posted up on our YouTube channel. Have a great day, guys.